It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, it's your Real Estate Breakfast, and now streaming on Spotify and Apple Podcasts from the top end in Darwin to the streets of Adelaide and everywhere in between. And good morning if you are in either of those locations, Darwin or Adelaide this morning. Well, the weekend, it has come, it's gone, it's rocked on by. Something I watched actually over the weekend on Netflix was called You're Going Straight to Hell. You might have seen this. This is a Korean miniseries. And the level of filmmaking now coming out of Korea, in most cases, I find that it is just simply much better than American miniseries or films for that matter. So I definitely recommend that. It is a Monday. It is May the 11th. Somebody famous celebrating their birthday today. Eric Burdon, lead singer of The Animals. You know that song, House of the Rising Sun? He is turning 85, and it was also on this day back in 1970 the Woodstock triple soundtrack album was released in the US, becoming a cultural touchstone of the era. And also on this day in 1981, Bob Marley passed away in Miami. You know, we forget just how young Bob Marley was. He was only 36. When we were younger, it seemed like he was a whole lot older, but no, just 36 years of age. As we take you off to Brisbane to catch up with PRD's head economist there, Asti Mardiasmo. And a very good morning to you, Asti. Welcome back to the Real Estate Breakfast. Got to talk to you about the RBA. Everybody's talking about it. You know, the cash rate, 4.35%. It is reset expectations, of course, for the rest of this year. And with the hike, do you believe that we have finally reached the peak of the cycle? I suggest no, we have not, Asti.
You're actually very much so right. The latest statement of monetary policy from the RBA, which was released on Tuesday, the 5th of May, suggested that our inflation rates are about to increase even further, at the moment being predicted to reach just under 5%. Like you said, our inflation rate is currently at 4.6%. So it's expected to go up to just before 5% around the June quarter.
Yeah, I was saying on Saturday with Gareth there from the NAB that the cash rate has now returned to levels seen back in December of 2024, mirroring the pre-pandemic environment of late 2011. You know, last year I was saying that, and this was when the rates were coming down, I was saying, look, go for safety, fix your rates, because you never know. The market might change. And I had people say to me, oh, yeah, no, probably better to stay with variable. You're going to save more money, blah-de-blah-de-blah. And yeah, look what happened. You know, we had this market bang. All of a sudden, you know, the rates are going up. How many of those people wished that they had fixed their rate last year? And I just come down to the fact that I think there's a bit of a greed factor. You should be thinking insurance first. It's okay to look at the greed factor of the best rate and all the rest of it. But if you're on the margins for a tight household income, you got to fix it.
I completely agree with you, Craig, because when you're fixing a rate, what it does provide is it provides stability. Now, I understand that there will be mortgage owners who would like to save money. Like you said, it's a lower interest rate. With the fixed rate, then you have to pay the same amount every month. Whereas if it's variable and if there's a bit of a discount, then you are saving money. But of course, on the flip side, if suddenly the interest rates go up, then you have to be spending more money. Whereas if you're on a fixed rate, it means that you have that outgoing cost as a stable outgoing cost. And so regardless of what's happening in the interest rate, you have stability in your outgoings, so you can always plan and prepare for it. And B, it means that, say, for example, if yes, the interest rate keeps on going down, what it means is that you are then increasing or buffering up your mortgage offset.
There's the wild card in all of this. So last year, part of the reason why I was saying there could be another global shock is the wild card factor of Donald Trump, because he's the one that's done this. He's created this global shock. It's one man. And that was why I was thinking, we're not out of the woods until he has left office. There could be another global shock between now and, 2028 that he is gone. That's a long, long time before we are into any sort of normality. Now, I want to talk about, you had a report, I think it was called Smart Moves, which was highlighting a significant pivot towards regional Australia. And as capital city affordabilities tighten, you've identified 10 regional LGAs that are outperforming metros on entry price and rental resilience. And it seems the lifestyle move is now being replaced by a calculated strategic move by many buyers. So beyond just lower prices, what specific economic fundamentals make these regional pockets safer bets in a high interest rate environment?
There's a couple of key indicators that we use. The first one, of course, other than lower prices, as you said, is that you would like some employment stability, and not only making sure that it's a low unemployment rate, but also an unemployment rate level that has either held stable over the past 5 to 10 years or one that has been decreasing. The other item that we look at is the amount of future project development that is committed to the area. Any new infrastructure, like whether it's new roads, new public hospital, new schools, education. So all of that is committed to these regional areas. And when you see that there is a high level of infrastructure and commercial projects, that will sustain the local economy in the area.
We are talking to Asti Mardiasmo in Brisbane this morning. In a moment, we'll look at what investors need to think about right now in this changing Aussie property market. That is next.
Remember to follow us on any of the podcast platforms so you never miss a real estate podcast. You can follow us on Apple, Spotify, and Amazon. Know your property with us. We are just as addicted to property as you are. The Real Estate Podcast.
Well, Sydney is home to some of the narrowest real estate in the world. Yes, not just in Australia. In suburbs like Paddington and Surrey Hills, you can find skinny houses that are only 2.8 to 3 metres wide. Why were they built so skinny, you might ask yourself? Originally, they were built as low-cost worker housing in the Victorian era, and these vertical homes have become architectural trophies. One famous example in Surrey Hills, measuring just 2.8 metres across, sold for millions of dollars recently. So the Sydney market scarcity of width doesn't mean scarcity of price. It is a Real Estate Monday. Asti is here from PRD talking all things property. Now, Asti, you recently explored how the definition of a family home is shifting. It's no longer just about the numbers of bedrooms or square meterage. It's about how a property facilitates a specific lifestyle. Is the lifestyle premium, do you think, still holding its value, or are buyers starting to trade lifestyle for affordability as rates climb, which you partly answered before the break?
Yes, so it's a really interesting market that we live in right now because there's always that question of what do I prioritize? We do have a larger client base that are prioritizing affordability, mostly because of, the current interest rate hikes, what's been happening across the world, and also how fast interest rates can change. Like you said before, and like how we discussed, we left 2024 at a certain cash rate percentage. 2025, we saw it being cut. And then 2026, we see it increasing again. And so that is actually a very, very small time frame for that amount of change in cash rate hikes and cuts. And so because of that, we do have a larger base of clients that are looking for affordability because they want to be able to ensure that they can service their mortgage with as little as mortgage stress possible. But at the same time, it really does depend on which life cycle that you're in.
Let's have a look at the investment sentiment for this year. Lots of investors are going to be saying to themselves, is this the time that I should buy a second investment property? While some investors are exiting, we've got others that are finding affordability-related opportunities. So for investors looking at that 4.35% cash rate, what is the number one indicator that an investor should look for before expanding that portfolio?
The first one that they need to look at is the rental yield and the vacancy rate, because the rental yield pattern takes into account the purchasing price of that particular property, the median price, so to speak, of the area versus the median cost of actually having a rental property in that area and the rental income as well. So it takes into account, this is the purchase price, this is the rental income, these are the costs, which include that mortgage repayment. So if you have a rental yield that is higher than, say, the related capital city, so for example, if you are in Brisbane, which is where I am right now, and say I have an investment property in Indooroopilly, if my rental yield in Indooroopilly is still higher than the average Brisbane, and it is also increasing, then that rental yield is still serving my needs as an investor. And coupled with that, I want to look at the vacancy rates, because the vacancy rates tell me how quickly my investment property will be rented. And of course, as landlords, I'm a landlord as well, we don't want our property to be empty. And the closer you are in the vacancy rate to zero, or if it's a declining vacancy rate, then the quicker your rental property should be rented.
All right, we will leave it there, Asti. Good stuff. Some nice tips there for the investor. Have yourself a great Monday and look forward to catching you back again another time.
Thank you so much for having me.
We don't just report on real estate news, we take you to the source of the information. We produce more property podcasts every week than anyone else. We are your trusted guide for all things real estate.
The market's pricing just under a 40% chance. But the market is expecting a hike here by July, and that's our expectation.
What an owner wants, what an agent thinks a property's worth is quite irrelevant. It's what somebody's prepared to pay for it. And running the auction process allows us to, filter through the buyers.
A lot of the major banks now have reset their forecasts to 2 or even 3 rate rises over the course of this calendar year.
And I'm very bullish on Geelong as well, especially for clients that are a little bit more yield sensitive. I think that that's where the best capital growth outcomes will be over the next 3, 4, 5 years, despite the fact that Perth's obviously going to outperform Victoria this year.
For some Australians, that will be as easy as calling your bank, because some banks at the moment are offering discounts of up to 0.2% or 20 basis points, which almost wipes out this increase.
We connect you to the best real estate information across Australia. The Real Estate Podcast.